Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Lawrence Gillum. Lawrence, we're going to talk stocks and bonds, as we usually do when we are together. Got a little earnings season preview and a discussion of corporate bonds as a potential risk-free asset. So how are you today?
I'm good. I'm still recovering from yesterday's Bucks game. Another nail biter to the end, but so far so good. It's been a fun season.
Yes, Buck fans enjoy it. Certainly, I hope I'm enjoying being a Chiefs fan after tonight's game. On Monday night, it is Monday, October 6th, 2025, as we are recording this Monday afternoon. And hey, we have another up day. I think we got a shot at 7 straight up days for the S&P 500. Here is the agenda for us. We're going to just recap the market action last week real quickly, then turn to the bond market update with Lawrence. Of course, that's his thing. The question he has posed and tried to answer is whether investment grade corporates can be the new risk-free asset. Hopefully, Lawrence, you don't get us in trouble with compliance using terminology like that. Third is the earnings preview. That's the topic of our weekly market commentary. This week, you can find that on LPL.com under the research tab, which you can always find every single week, or at least about 49 weeks a year, maybe. I think we take a couple holidays off, but 49 or 50 weeks a year. And then we'll close, of course, with a preview of the week. And our week ahead data calendar is pretty quiet, and it might get even quieter because of the government shutdown, which probably goes through this week and into next week. We shall see. All right, so starting with the market recap. Here, I'll do the stocks, and Lawrence, you can do bonds. On the stock market side, another solid week, up 1.1% on the S&P 500. Even better on the NASDAQ, up 1.3% for the week. Russell 2000 small cap index up almost 2. We've been talking about how we like the small cap index as a trade on the Fed rate cuts. And maybe now you get a little seasonal lift because October is here. I think there's really 2 themes that were prevalent last week. One was certainly AI. We had a strong week for tech, up 2.3% on the week. We had an open AI private valuation of $500 billion for the market to digest. That is a lot of value for an AI model or AI models, which put a pretty strong tailwind behind tech. But the star of the show was healthcare, and there it was all about policy. Essentially, the drug pricing controls proposed by the Trump administration and the exemptions, tariff exemptions for Pfizer to invest in the U.S. Got investors really excited to finally buy healthcare after the sector had struggled. It's one of the worst performers, not just this year, but in past years as well. You see here down almost 3% over the last 12 months. Big laggard in 2025, although with that latest rally, it is up almost 7% year to date. I think those were the 2 big drivers, but then behind all that is, of course, the market shrugging off the government shutdown, clearly pricing in that this thing's going to end before it does any meaningful economic damage. Also note the international markets were really strong last week. You got a 3% gain basically in the EFA for developed international markets and an almost 4% gain in the emerging market index. So strong week for international stocks, certainly a good week for U.S. stocks as well, despite the shutdown. So let's go to bonds, Lawrence, and then maybe we can share the commodities story.
Yep. So last week was another decent week for the fixed income markets. Aggregate bond index up about 50 basis points in a week that didn't have a lot of major economic data, as well as no real treasury auctions for the market to digest. It was good to see that seemingly there was a lot more buyers than sellers in the fixed income markets. That's generally a good sign, given all the concerns about treasury debts and debt levels and deficits and all that kind of stuff. So that was a positive sign last week to see some relative interest in the fixed income markets. Treasuries up only about 40 basis points, but IG Corp's up about 60 basis points on the 5-day period, up over 7% this year. We're going to look at spreads in just a second and kind of discuss or talk through that title of the fixed income section. Can investment grade corporate credit be the new risk-free asset? But the rest of the markets, worth pointing out, munis are again showing some signs of life. Still underperforming relative to a lot of the taxable markets, but over the past 3 months, you have a positive 3% 3% return out of the muni bond index. It has firmly come up above the negative line, which it had been sitting there for most of the year. So it's good to see the muni markets participating as well. Outside of that, plus sectors, high yield bonds only up about 20 basis points, preferreds only up about 20 basis points, EMD up about 20 basis points on the week last week. So altogether, a pretty good week for fixed income markets, with the core sectors, the higher quality sectors, outperforming some of the lower quality sectors in the fixed income markets.
And I always look at the year-to-date number for the Bloomberg AG, the Broad Bond Market Index, up 6.4%. That is a pretty solid year, certainly for bonds. And the year's not over. So could have a great year for stocks and bonds. Looking at commodities real quick, I mean, the oil was down about 3.5% last week. That was a drag on the energy sector, certainly one of the worst performers last week. But the gold rally, gold didn't get the memo that commodities are supposed to be down, because gold just keeps going higher. Look at this, 18% higher in the last 3 months and almost 3% last week. I'm sure a lot of folks out there have $4,000 targets on gold. We're not that far away, less than $100. Gold continues to benefit from a rate cutting cycle globally. Geopolitical risk is elevated, and at least in the US, you've had generally a downward trending weaker dollar. So all those things positive for gold. Oh, and by the way, lower rates. I know I'm talking about your world, Lawrence, but lower interest rates tend to be good for gold as well. And the central banks continue to buy. So that continues to be a metal that we like. Although generally speaking, we still think equities should be able to generate higher returns than commodities. So then turning to currencies, the dollar was up last week, so the gains in international markets were not currency driven. They were pure. So that, I think, is worth noting. International continues to lead, certainly the US on the currency bounce, but last week got a little bit of a gain ahead of the US in local currency. By the way, the yen's making a lot of news today on the surprise election result. So it looks like we're going to get maybe a little bit more, Abe 3 arrows than the market expected, a little more dovishness than the market expected, and that is putting some downward pressure on the yen today. So that'll be something to watch. In addition to the France political tension or uncertainty, which we'll save for another day. So let's get back to you, Lawrence, on the bond market update and this question that hopefully our lawyers are good with. Can investment-grade corporate bonds be the new risk-free asset? So you've recently published a piece on this question. First slide, not much happening in rates.
Yeah, so this first slide just is a recap of what happened in the rate market last week. And as mentioned, there wasn't a lot of economic data, no treasuries to digest, so rates didn't really do much here in the U.S. We did see a little bit of steepening in the curve, so the 30-year tenor was up about 4.5 basis points, whereas the 2-year tenor was down by 3.5 basis points. So we continue to see the curve steepening, which is, I think, the expectation throughout the rest of this year to see something along these lines as well, to continue to see steepening in the curve. You mentioned France and Japan. We are seeing upward pressure on long end rates here in the U.S. because of what's going on in Japan and France. Today we are up about 4 or 5 basis points on the long end of curves because of that political dysfunction, which apparently we do not have a majority of in the U.S. We don't. It's not just here in the U.S. There's other countries out there that are dealing with their own issues. France is a big one, but with Japan, call it I don't want to call it an upset victory, but it was maybe one that markets weren't really prepared for, as per the price action out of the rates market with Japan. The 30-year tenor for Japanese government bond yield is up about 14 basis points today. So they are certainly pricing in a lot more fiscal stimulus, lower or easier monetary policy, et cetera, after this election. So that has hurt the fixed income markets here in the U.S. as well. So given all the political dysfunction in the world and all the debt and deficit spending that's taking place within the developed markets, there was a question recently posed by the Wall Street Journal, in fact, is can investment grade corporate bonds be the new risk-free asset, given all of what we just talked about with the big political dysfunction and debt and deficit spending. So if we go to the next slide, I do try to answer that in my newest publication piece, the Rate and Credit View, LPL Advisors. Go to the Resource Center and you can search for Rate and Credit View if you want to read more about this. But this first chart is just looking at spreads. So spreads to treasuries are still around secular tights. This just looks at the difference between corporate bonds yields and treasury bond yields generally, and come up with a spread to treasuries right now at around, call it 72 basis points. It's amongst the tightest it's been in quite some time and as low as they've been since around 1998. And importantly, if you think markets are right, or if you believe in the wisdom of crowds, given current pricing, markets would suggest that there's not a lot of risk within the investment grade corporate bond market because spreads are as tight as they are. So it's an interesting question. Certainly we don't agree with it, but markets perhaps are suggesting that investment grade corporate bonds are generally risk-free. Now, the next slide is one of the reasons why we're seeing spreads as low as they are is because we have a tremendous amount of buyers that are buying yields regardless of what's happening in the spread market. So this is pension funding levels. So this is looking at the 100 largest pensions in the U.S. And their funding levels. When you have a funding level above 100%, that means your pensions are fully funded, your assets are above your liabilities, so you don't need to take on as much risk. And we're seeing a lot of interest in the fixed income markets because of these pension investors that are buying bonds, holding to maturity, regardless of the current spread environment, and that's helping push spreads down below to what they should be given current economic conditions. We're also seeing a lot of interest out of the non-U.S. market as well. A lot of foreign buyers are buying a lot of investment-grade corporate bonds this year as well. Once again, just buying total yields and not necessarily concerned about spreads. So, in the piece, I try to make the argument that despite what markets are pricing in, spreads are way too tight given the underlying economic conditions because of all these yield buyers out there that continue to buy bonds and hold to maturity.
Yeah, and they're probably a little bit nervous about treasuries given our deficit situation. So, I mean, in fact, you have some AAA ratings, right, Lawrence, on the corporate credit side?
Right. So it's interesting. There are two companies left that are AAA rated on the investment grade corporate side. Can you guess them?
I think Microsoft and J&J. Is that right?
That's right. So Microsoft and J&J. Apple is.
How about that from the equity guy?
I know.
Pulling that out of his hat.
So Apple. Everyone says Apple, but Apple's AA plus. There's a lot of market pricing out there that suggests that there's a handful of companies that could be, in fact, risk-free. The argument and the way I would push back on that is, again, the exuberance for all-in yields is distorting market pricing, and we haven't had a negative kind of credit event in a while. So I think if the economy slows or even contracts a little bit, you can see some spread widening, particularly in these companies that have negative spreads. It's one of those things where we talk about it internally. It's like picking up nickels and dimes in front of a steamroller. You don't know when that steamroller is going to come, but there's always that risk out there. Now, the question we get is, how tight are spreads relative to economic conditions? And this is the next slide. So this is just our LPL research spread model. This takes into consideration financial conditions, the interest rate environment, and some fundamental economic data. The line here on this chart is the difference between actual spreads and our forecast spreads based upon our model. So the difference between those two inputs, you are starting to see a pretty big divergence between what underlying economic conditions would suggest these markets should trade at versus what they are trading at. And right now, the investment grade corporate spread based upon our model is about 34 basis points too low. So you should have a spread to treasuries around 1% or even higher than where they are currently. But we are getting that distortion just because of all the all-in yield buyers. So I guess the takeaway is, despite markets pricing in the prospects of a risk-free asset with investment-grade corporate bonds, our view is that spreads are way too tight given these economic conditions, and it wouldn't be surprising to see spreads widen, if and when something happens within the economy.
So, Lawrence, this is not based on significant widening and not widening, increases in delinquencies or anything fundamental, right? This is really just saying that based on history, based on what the environment looks like now, here's where spreads should be.
That's right. So if you look at the interest rate environment now and you compare it to history, if you look at kind of the financial conditions now compared to history, and if you look at kind of some of the fundamental data that we look at for this model compared to history, you add all that up together, and spreads should be about 34 basis points higher than they are currently.
Okay, but just to be clear, we haven't really seen much of a deterioration in companies' ability to pay.
Not at all. Not at all. And so, yeah, I mean, and keeping and taking into consideration as well that a 1% spread over treasuries is kind of a decent spread to treasuries relative to history. So we're at 72 basis points now, which is the tightest we've been since 1998, suggesting that markets have priced out or haven't really priced in a lot of other risks out there, despite the fact that there are some risks out there with the interest rate environment and elevated inflation and all that kind of stuff. So bottom line is, investment grade corporate is way too expensive, we think, to have any sort of meaningful exposure to in our portfolios.
Yeah, we know we continue to be a little bit cautious on corporate credit, and certainly aren't doing what the market's doing and paying a steep price for it. I guess you could say that stocks and bonds are actually trading like 1998, right? You just made that comparison. I think a lot of people are comparing this AI boom to the dot-com boom in 1998, 1999. There are key differences. That actually is probably a good topic for a future podcast, but I'll leave it there. But just know spreads were very tight, and certainly there was a lot of capital investment going on there, as we all know from history. So thanks for that, Lawrence. Let's do a quick earnings preview here, which is, again, taken from the weekly market commentary on LPL.com. So I titled this "Expect Little Suspense" because based on the economic environment, we really didn't have an inflection point of any kind economically in Q3. Steady economic growth, continued surge in AI spending, and a weak dollar. Those factors alone should get us to double-digit earnings growth in Q3. So consensus is 8%. We think we can get something in the low teens if the historical pattern holds of companies beating estimates by somewhere in the range of 5 to 8%. Now, last quarter, the beat was closer to 8% because you had a lot of analysts too low because of the Liberation Day tariff event. Once companies reported Q2, analysts were able to get kind of back on sides, get to a more realistic place for tariff expectations. Now they're there. They're in a pretty reasonable spot. There's not going to be another sort of tariff earnings adjustment, right? So look for something in the neighborhood of maybe 5 to 7% upside to that 8% consensus estimate. That's a very, very strong number. And you can see here that could potentially be the start of a string of double-digit earnings increases. We got two last, or actually we're three in a row now. If we get one this quarter, decent shot, we get one in Q4, and then on to 2026. So the potentially market is buying ahead of that. The Mag 7 are going to continue to be a massive driver. You can see here that those companies are expected to grow earnings 14%. That's consensus. So if they get the 5 to 7% upside, you're already about 20. And then actually their record's been bigger upside surprises. So, you can see something even north of 20%. These companies are so big that that's going to be a huge driver. In fact, of the 8 points that the S&P 500 EPS is expected to increase in the quarter, 70% of it is Mag 7. It's like 5.5 points, almost 6 points out of the 8. That is a massive driver, and we know that spending is coming. Not only is it coming this year, it's coming next year too. So that's going to be another, 6 quarters at least, we think, of Mag 7 being a strong driver, or just AI CapEx in general being a strong driver. We're probably going to get about $400 billion of CapEx this year in AI, and could get close to $500 billion next year. These are just really big numbers that put a strong floor under S&P 500 profits. Margins are probably going to keep going up. This is really amazing because tariffs were supposed to be a drag. Now they are a drag, but they're just being drowned out by productivity increases and AI revenue dropping to the bottom line. Companies have done a great job of managing the tariffs. The tariffs aren't as bad as we had thought or feared. You have exemptions, you have substitution of products, you have companies moving supply chains to avoid them, a whole number of things. So remember back in April, we thought we might get 20% plus for an overall national tariff rate. Now it's looking like 13 to 14 is where we're going to land. We'll see. There's still uncertainty there, but companies can manage that amount of tariffs pretty well. And with everything else supporting earnings, you're going to have, we think, a steady increase in margins over the next several quarters. So very good margin picture. The estimates have been trending up. This is another reason to expect above expectations for Q3 because estimate trends are positive. I think it's actually worth noting that 2026 earnings estimates have been rising just in the last few months. That is rare. It's possible it won't continue in Q3 earnings season, but for now we're going to treat that as a positive signal. So while we have been talking about $280 in earnings next year, or maybe $285, based on these estimate trends and based on the macro environment, and by the way, you have stimulus in 2026 from the One Big Beautiful Bill Act, and you also have a massive amount of buybacks that are coming through and probably will continue that boost EPS. There's a realistic possibility that earnings grow 10% next year, and that puts us around 290. So maybe we have to start thinking about 285 to 290 as our earnings range, not 280 to 285. We haven't formally changed our estimates, but certainly we have a bias to raise those. So good earnings season expected, probably no big surprises. Estimates rising probably suggests that guidance will be pretty good. We'll see, not always, but usually. And we think more earnings, good earnings ahead. So again, weekly market commentary, earnings preview. It starts at the end of this week with Pepsi and who's the other company that reports? I think Constellation Brands, Pepsi, and Delta Airlines are the three that have September quarters that report this week, but next week's the banks. So really next week's when it really gets rolling. But you'll get a little bit of a taste this week. And I think as the market focuses on earnings and not the shutdown, that should be good for the market environment. At least let's hope. So not that the market needs much help because we just keep going up. It'll stop at some point. All right, week ahead, Lawrence. Here's where I'm going to bring you back in. A quiet week of data, and it might get quieter because we might not get jobless claims. We didn't get jobless claims last week. We didn't get a jobs report last week because of the shutdown. But we will get some data, and Fed minutes is one such thing we'll get.
Yeah, so it is challenging to kind of come up with a mosaic if you're just looking at government data. I know that our chief economist Jeff Roach has talked about using alternative data to come up with any sort of economic forecast. But yeah, the absence of government data is making things a little bit harder for the Fed. So we will hear from the Fed this week. I think there's a lot of Fed speak this week. Along with the FOMC meeting minutes that'll be released on Wednesday. 20 Fed speaking engagements, I think I saw that are scheduled for this week. So
Powell's on the docket.
Powell is on the docket as well. So you have no economic data, but a whole lot of Fed speak. So we'll have to see how that translates into market volatility. The other thing you have highlighted here is the University of Michigan sentiment. This is the preliminary one. This tends to be revised going forward, but it has at times moved markets. So we'll have to see how that plays out. And the only other thing that's not on your list here is there are some Treasury auctions this week. So despite the government shutdown, Treasury still operates as per usual. There's a 3-year, a 10-year, and a 30-year auction this week. So we'll have to see how that 30-year auction in particular goes. Given just the lack of demand globally for a lot of these longer maturity securities. So I always say this and I always regret saying it, but hopefully it's just a quiet week across the board for markets, but because I said that, it won't be.
Well, we'll see. You could argue that no economic data means no sell catalyst. And maybe we'll just keep drifting along the path of least resistance. It appears, at least for now, is still higher. We got more AI support from the AMD announcement this morning, deal with OpenAI. So, trade from last week continues this week. Maybe we'll get something from the Fed that causes folks to get a little nervous. We'll see. Maybe something geopolitically. We'll have to see. I guess Trump is meeting with the Canadian Prime Minister Carney. I think there's a meeting coming up with the Brazilian president. So we always got to keep our eye on those things. But for now, it looks like the seas are pretty calm. So if we do get unexpected volatility this week, Lawrence, I'll go down with the ship with you.
All right, appreciate that.
I'll be wrong. I'll be wrong as well because I think it's going to be pretty calm. And by the way, nothing's going to happen on the shutdown this week. The House isn't in session. There's really no catalyst for a quick settlement there. We're probably going to have to wait 2 weeks, maybe even 3 weeks, which is how long the shutdown in the mid 90s and in 2013 lasted. And those are the ones that people are comparing this to. So buckle up. I mean, it's obviously disappointing. We want federal employees to be paid. Some of them are getting furloughed. Some of them are working without pay until this thing is resolved. It's very unfortunate, but at some point, the pain gets too intense, and the sides will come together. I think that's why the market's shrugging it off. The market knows, and I think rightly so, that this thing will be over. Probably in a month or less. But when you start looking at what might happen in November if this keeps going, you really, the amount of pain is potentially quite high in terms of economic impact and, TSA lines for Thanksgiving. You take away the TSA lines in Thanksgiving, you do not have a winning political strategy. And if you at some point, we don't expect this to happen, but if at some point you delay Social Security checks, you have a losing political strategy. I am being sarcastic. We are not going to see Social Security checks not come in the mail. Trust me on that. So at some point, there are these pain points that will push the two sides to come to a deal. They're just trying to score some political points right now. We'll see how it goes. We'll keep following it, but for now, probably nothing doing.
October 29th is the next Fed meeting. So if they don't have their economic data by then, that could get pretty dicey for the Fed as well. So we'll have to see about the alternative data. But October 29th is the next Fed meeting. So
I think Mr. Powell might have to call Jeff Roach and ask him for his set of alternative data. He's got a lot of it. So yeah, let's hope this thing's over by October 29th, but certainly there's a very real possibility that it goes beyond a month. Trump 1.0 shutdown, off the top of my head, I think went 35 days.
It sounds right.
So it could be longer. So buckle up. We have written a fair amount about that topic. The stock market tends to go up during shutdowns, at least over the last 30 years, modestly, but still generally stocks shrug these off. And we expect this time to be no different, although you never know what other catalyst is going to come along. So with that, we'll wrap. Thanks, Lawrence, for jumping on this week's Market Signals. Thank you to all of you for listening or watching. Really appreciate your support. We'll be back with you next week. Thanks again for joining. Take care. Have a great week, everybody.